Today's video comes from a conversation I had with a friend, and we were just talking about stock market and timing the market, things like that. And you may have heard, it's pretty common that people say you can't time the market. And I happen to very much agree with that, but I did want to bring some context to it. Like, what does that mean? So let's break it down. First, I want to talk about turning points. Basically, that's the time that a stock would go up, stock would go down, or a business cycle is going to change one way or another. So you're trying to time the date and the turning point behind that. Second, we're going to talk about business cycles, and third one, we're going to add intrinsic value. So let's look at an example. Easiest way to understand something is just through an example. I wouldn't get too tied up in these numbers. They're more for illustration's sake, but let's run through it. So we're looking at time frame and probability. And we're going to take an example of the S&P 500, and in this case, we're 20% overvalued its intrinsic value, meaning that the stocks of the S&P 500 are overvalued by 20%. So it's not necessarily the best time to buy, and we've had a really good run up in price where the company's earnings haven't quite caught up to it. Second, in the business cycle, let's say we're in the late expansion. So those are the two variables and kind of the consensus behind where we're at. Now, we're going to make a couple of assumptions. One assumption is that business cycles will continue. You're going to have ups, you're going to have downs, and no one knows exactly how long they're going to last, but they will happen. Second is that the company's stock price will revert back to its intrinsic value. So that means that along with the business cycle, the stocks are also going up and down. And the third is just more of a rule of finance, and that a company's price grows. A company itself grows. Well, the way you get overvalued stock is that the price is growing faster than the financials of the company. That has to break some time. So one of the rules of finance is that the price cannot continue to grow faster, the stock price that is, than the company's financials itself. And that's more on the aggregate. So that's what the rule is. Now let's look at how this applies. First off, oftentimes you'll get the question, when do you think it's going to turn and why do you think it's going to turn? Or it could be, when do you think it's going to turn and I think this is why it's going to return. Because people will get really tied up to the when and to the why. And that's where, if you talk to the best investors ever, they'll say, that's almost impossible. No one knows when, and there's thousands of reasons why, one way or another. So it's not about necessarily knowing when and why. It's understanding the variables and then the probabilities behind the time. As an example, let's just say that we feel that we're running probability analysis and we say, it's going to revert back. So say a $100 stock is going to go back down to 80, and then we're in the late expansion. So we're probably sometime in the next 2, 3, 4, 5 years going to hit that $100 down to 80. We just don't know when. It's the probability, the longer the time period, the higher the probability is going to happen. So kind of easy to understand is that if you're trying to figure out something over the next 30 days, 6 months, 1 year, less likely to know when that turning point is going to happen. So the probability, and these are kind of just made up, but the probability of hitting this turning point in the next year might only be 20%. Whereas the probability of it hitting in the next 4 years, so anytime in the next 4 years, might be closer to 80%. So just understanding the longer you wait, the more likely it's going to happen. And that's a better way to look at it, to put it in perspective, is that we don't know when or why. It's just that the longer it waits, the more likely, assuming that we're going to have business cycles continue, that it's going to do that. All right. Another important thing when it ties to investing is that when this happens and we're 20% overvalued, it's not all or nothing. Because you can't time it, you're not going to say, I'm going all bonds or all stock. You want to be more strategic, but also smart with your money, whereas like, okay, I'm going to maybe take some off the table. I'm going to take, my stock have run quite a bit up. I might sell some of it. So it's understanding what's the right probability. And then third, if you are trying to make an expected return forecast with bonds and stock, then the way to do it is just look at, well, we know that companies are going to continue to grow. We assume companies are going to continue to grow, is how long will that growth be? And if say it takes all the way 5 years for it to revert back to its intrinsic value, well then just let's look at that. And then how does that tie up to the bond? So you can make a projection bonds and stock. Bonds are easy if you're just assuming the interest rates will remain the same. Stocks are harder, but also if you say, well, it's not likely, but it is likely sometime in the next years, let's just assume it takes the longest. And what's the price point that I can assume in those two scenarios? So hopefully this is helpful. This is some ways that we look at it and understanding it's not the when and the why, but it's really understanding time frames. And the longer you wait, the higher the probability that the turning point will happen.